If you're investing in commercial real estate, what you're buying is the net operating income. This is like the bread and butter of brokerage. 7 things why this is important, and then we'll jump into how you actually find it and some of the pitfalls that you run into, some of the common mistakes. There's other stuff that goes on in a deal after you figure out the net operating income before you understand how many dollars land in your pocket. The bigger that spread is, the higher the NOI is. The higher the NOI, the higher the
value.
Yes, the higher the value of the property, right? Just because this is how it's supposed to be done doesn't mean that any owner out there isn't doing their books however they want to. You get to do your books however you want to, unless you're audited.
Straight to jail.
Regardless of what the cap rate does, which you can't control,
right? You
can manage the property to increase the net operating income, which means the property is producing more profit.
Net operating income.
We hadn't done one of these in a while.
I know.
Just me and you.
That's right.
This episode is sponsored in part by the Massimo Group. Are you a commercial real estate broker looking to boost your business? The Massimo Group is the world's premier coaching organization, transforming the careers of brokers just like you, just like it did for me. Visit www.massimo-group.com today to get started and take your career to the next level. This episode is also brought to you by Site to Do Business, commercial real estate's most advanced toolkit, providing commercial real estate professionals like me with premier data, mapping, and marketing tools to win business and revolutionize decision-making. Visit stdb.com to learn more.
Since our last recording session, you've had a birthday.
I have.
Yes. And I wanted to tell you too that you are an incredible big brother. Like as all your 5 siblings would say the same thing. You look out for everybody, right? Not only that, but you're like an incredible example to look at and to follow as you continue to grow as a person, and then how you are as a husband. And then especially since I have kids now, to get to know your kids and how much they love you and Autumn so much. It's an incredible inspiration. And happy birthday.
Well, thanks, man.
Yeah.
That's incredibly kind for you to say.
Well, it's true.
And it's one of the things that's fun for me is watching Maddie babysit your daughters.
Right.
Like she loves your daughters.
Yeah.
And it's just cool to see our families connected in that way as well, that they actually get to spend time together and stuff. Because look, Maddie is 15. Mm-hmm. Your daughters are
7 and 3.
7 and 3. So like the difference between Una and Maddie is about the same difference as me and you.
That's right. Yeah. Yeah.
It's kind of
that's right.
Crazy to think about.
I know. Well, welcome to Commercially Speaking. I'm Timmy Barron, ADHD.
And I'm Bo Barron, CCIM, and this is 1 year older.
1 year older, baby. And this is the Commercial Real Estate Podcast where Bo teaches me everything about commercial real estate, investing, brokerage, because I started not knowing a thing. I know a lot more now.
You do?
Yeah, that's right. Yeah, I'm actor, comedian, the founder and creator of Tisby, All Disc, No Balls. We just finished our first.
What a great tagline. All Disc, No Balls.
All Disc, No Balls. I got to send you the video we just finished, like the first official Tisby video.
Oh, like the how to play rules. I saw you working on it a little bit. So yeah, I'd love to see it.
Yeah, we got that.
Matter of fact, put it in the show notes.
Okay, yeah.
Because look, for those of you who might wonder what on earth is this all disc no balls, imagine tennis on a tennis court with a modified net or an addition to the net, and you play it with a frisbee instead of
a racket
and balls. So
no balls. Yeah. So tennis plus frisbee equals
and
Tisby.
Then sprinkle in the personality and humor that you would expect to get with my brother as the creator or the co-creator of this sport.
Fun fact, if you laid a blue whale lengthwise across the tennis court, they'd have to cancel the game.
And that's what you've got. And so I've played it a number of times with you. It's a lot of fun.
So fun.
Anybody can do it.
Yep.
And, you don't have to have a great serve or, a great backhand or any of that stuff. And it'd just be really Cool. Check out the video in the show notes.
Yeah,
Timmy
I'll put it
will,
up there.
yeah, Timmy will stick it in there, and you can.
Tisby.com. It's up now.
Nice.
Yeah.
And spell it.
TIZBEE.
.com. Well, cool. Well, before we get into what we're going to do today,
Yeah.
I wanted to kind of circle back to the episode we did with Wes Gay
Yeah. Okay.
on story and marketing and all that. We had a great conversation with him. I forget what episode it is, but Timmy will.
I think it was the first episode of season 2.
It might have been.
Yeah. But yeah,
you can
I'll
link it below or up here or wherever. And one of the things we announced on that podcast is that Wes and I are going to do a CRE marketing mastermind where we're going to help commercial real estate brokers figure out how to do marketing well. Like, how do you actually do marketing that drives real leads and real sales?
Right.
Because look, not you.
I love when you do that.
But commercial real estate brokers aren't good at marketing. There are some exceptions out there, and again, not you, but we generally don't do it well. And what we hear is do this and do this and do this and do this and do this. And there's this overwhelming avalanche of advice that we hear all the time. And add in social media and mail or don't mail and email and CRMs and funnels and
Billboards,
all that,
ads at the baseball game,
all this stuff. And then add in like geofencing and all this crazy new tech stuff. And like, it's overwhelming. And guys that are out trying to do deals all day don't want to like go through the brain damage of the trial and error to figure out what actually works. Well, that's why Wes and I have teamed up to create this CRE marketing mastermind, and we're going to launch it in May.
Okay.
It's going to be 7 sessions. We meet every other week, live sessions, direct interaction with me and Wes, or it'll start in May. We're going to launch it probably a handful of weeks before that. But if you want to be notified as soon as there's more information about this, is go to wesgay.com. That's WESGAY.com/CS for commercially speaking. And you can just throw in your email. And once we have the information solidified and we actually open up the mastermind, we're just going to take 40 folks through the first group.
Nice.
And it's going to be, I think it's going to be really effective. But here's kind of the program objective.
Okay.
We're going to help brokers create a marketing plan tailored to their business needs. Or in other words, if it doesn't drive leads and sales, it's not really worth doing. All right. So what are the things that actually work? We're going to equip participants with the tools and systems to grow their audience and increase their transactional velocity. This is all about creating more consistent and growing deal flow, which is kind of the holy grail in commercial real estate. If you can create that deal flow, you can prolong and grow your career. We're going to empower brokers to lead their marketing efforts without necessarily executing them themselves. All right. So we're going to create the plan, the systems, and give the tools that you can hit play, and it just happens.
Yeah.
So it's not something you have to do every day. Create a clear plan and the tools to execute it quickly and easily for an entire year. So you're going to leave with a plan for the entire year. And the ultimate thing here is, we've got over 20 years of marketing and commercial real estate experience and expertise. We're going to boil that down into one easy to execute plan while skipping all the expensive trial and error training and avoidable mistakes. Like, that's really what this is all about. And so if you haven't already, I'd encourage you to go back and listen to that episode with Wes Gay.
Good.
But also go to wesgay.com/CS, throw your email, and when we've got more information to announce about that, we'd love to have you participate. I think that's going to be really good, very helpful,
it's huge.
and it's going to grow businesses.
Yeah.
And simplify the whole marketing side, whether it's ignored or done poorly or just all over the place. And I promise that we won't have you doing TikTok videos like residential realtors. Okay. As much as I enjoy them, that's not us. That's not what we do. That's not what we're going to have you do. Okay. So little PSA there.
Cool.
So today though, I got this didn't happen today, but this gets into what we're going to cover in today's episode.
Okay.
I got a message on LinkedIn. Actually, I was just tagged in a post on LinkedIn from a guy named McNeill Stout.
Okay.
And this is what he says. I'm convinced there's an informative podcast out there for every subject that exists. Therefore, if you don't know something, you don't have to go to school for it or even buy a book. You can just look up the best podcast for it and become an expert in weeks. A unique time we live in. There's no excuse for not learning. The information is readily available. I totally agree. And then in parentheses at the bottom of this post, it says, one of my favorite CRE podcasts that I recently started listening to is Bo Barron's Commercially Speaking. So he tags me in that.
Yeah.
Like, hey, that's great. Thank you. So I respond to him, thank you very much for the shout out. And we really appreciate it. And we really do. McNeill, thank you.
Yeah. Thanks, McNeill. That's
but
great.
I asked him, I was like, man, what's something we could cover that would benefit you?
Yeah.
And he said, man, I need a crash course. He didn't say I need, but he's like, a crash course on 101 would be great. Now, what we do here is I teach you commercial real estate, investing, and some brokerage stuff.
Right.
Yeah. But I teach 102, which is market analysis. And so this podcast has a very 102 flair.
Sure.
Okay.
Sure.
But 101, we talk about that stuff a lot too, but we've never really focused on a 101 topic per se.
Yeah. I
we
guess right.
have a little bit, but so I was thinking, man, if we can't really do a 101 crash course. I haven't had that class since 04 or 05, and I don't teach it. But I do know there's something in there that we've mentioned this term over and over and over again since we started this podcast, and it's not cap rates, okay?
Yeah.
Though that's a 101 topic.
Yeah.
And it's in all the other courses too.
Sure.
But there's another topic that we talk about, or another term that we talk about that I think like in some ways how to use this term, but you probably don't know how to come up with the term.
Okay.
Like actually like why it's important. We've never really talked about this term specifically.
Yeah.
So any guesses as to what it is?
Can you give me a clue beyond what you just said?
Well, it's
and I love this, by the way, that getting that comment, we read the comments, leave a comment wherever you're listening to this. If you want us to cover something, by the way.
Yeah, look, you have the ability to program our show.
Yeah, we love it.
And it helps us.
Yeah.
And it, we like creating for you.
Yes. That's why we do it.
Yes. So let's see. It has to do with income. Okay. It has to do with, it's involved with cap rates often. Okay. So just from that, I bet you can get it.
Income involved with cap rates. The the cum cap, the income cap, the cum cap.
Sock cap. Income
Sock cap.
Oh boy.
What's
the formula for cap rate?
NOI. Yeah, is that what we got?
That's what it is.
Income?
Net operating income. We're going to talk about net operating. For some of you, this may be completely elementary and might be a good review. Some of you have probably heard this term over and over again. You probably don't get lost in the sauce when you hear it, but you may not understand completely why it's important.
Right.
So what I thought we would do today is go through why is it important? Like, how is it used? And then I'm going to take you through how we actually find that number.
Let's go.
Every income producing property has a net operating income. It's a number you can figure out. Like it's not, you don't have to guess. You may not have access to the information that you need to figure it out, but like assuming that you do, you can figure out what it is. Okay.
Right.
So let's talk about some of the reasons this is important.
Okay.
Okay. And I think I've got 1, 2, 3, 4, 5, 6, 7. So seven things why this is important.
Love
how we use it. So I'm going to give you a list of 7, and then we'll jump into how you actually find it and some of the pitfalls that you run into, some of the common mistakes you make when you're trying to figure out what NOI is.
Okay, great.
Did you have anything? I've just been rolling since we started.
Oh, let's roll.
I didn't know if you had jokes or...
No.
Okay.
I mean, I wrote something
Card
yesterday.
trick or...
I wrote something yesterday. It's crazy. I wasn't planning on sharing it, but it'll be out on my TikTok soon. It's crazy. Anyway.
All right. So follow Timmy on TikTok since we still have TikTok.
Yeah.
Oh, by the way.
Yeah.
It's Valentine's Day.
Happy Valentine's Day.
Yes.
Happy Valentine's Day.
Back to NOI.
7 things.
7 things. Okay. So first thing is it is a profitability indicator. NOI, net operating income, directly reflects a property's profitability by measuring the income generated after accounting for operating expenses. Or in other words, what is net operating income in the first place? You take a look at the property's income, you subtract out the operating expenses, and what you're left with is the net operating income.
Yeah, okay.
Or in a lot of businesses, that's your profit. You know, your income minus expenses is your profit. So NOI, if you're examining a deal, if you're underwriting, one of the first things you do is you figure out what the NOI is. If the NOI is given to you, you're going to try to validate it, right?
Yeah, okay.
And it gives you an indicator of profitability. Okay, right off the bat. It's what you're buying, in fact. If you're investing in commercial real estate, what you're buying is the net operating income.
Right.
That's the income you expect to receive the year after you buy it.
Yeah, okay.
That's NOI. That's what it is. Okay. It's also, second thing, is a valuation tool. This is what we were referencing. It's a key component in determining a property's market value. Now, how do you figure out the value of a property? How would NOI help with that?
You use the
brokers?
cap rate
Yeah. And so,
the net operating income, and that's how you get your value. So you multiply them or divide?
you divide the net operating income by the cap rate.
You get your value.
And that gives you the value.
Yes.
So it's a valuation tool.
Yep.
All right. You cannot run a cap rate equation without knowing the net operating income.
Correct.
Now, if you know, just like any algebraic formula, this is the thing I loved about math. If you had 3 variables and you know 2 of them, you can always solve for the other one.
Right.
So if you have the price of a property and the cap rate, you can do the math and figure out what the NOI is.
Right.
If you have the NOI and the value, you can figure out the cap rate.
Right.
In this case, if you're trying to value a piece of property and you know the NOI and you can ascertain what the cap rate is for that type of property in this market, then you do the math and you can say this property should be worth about this. Now, recently, actually just Wednesday, 2 days ago, we put a portfolio of duplexes under contract. Yes. Woo. Thank you very much. First thing we had to do when our sellers reached out to us to try to hire us, we gave them a proposal on the property, and part of the proposal is they didn't have a real clear idea of what they were worth. They're out-of-state sellers. They own, 6 duplexes on the same street. And so we went to work. We got from their property managers their financials, the T12, the trailing 12 months. And we figured out what the net operating income was. That's the first thing I had to do was I went through all the stuff.
Yeah.
And one of the things I had to do was pull out capital expenses, CapEx dollars that they spent. We'll get back to that later on.
Yeah.
But when you look at a P&L on a property that you get from a property manager, and at the bottom it says, net cash flow or net profits or whatever they call that, what NOI line would be.
Yeah.
There's actually in a P&L, profit and loss statement, there's a number of things included in the expenses that you don't include. Right. When you're figuring out your net operating income. So you have to work through all of that. I ended up having to ask them for a list of all the actual expenses for the year.
Right. So you can.
And I went through each one. I was like, is this an expense? Is this a capital expenditure? Is this something else? Sometimes owners of property will run like personal expenses through the property.
Sure.
Which is fine unless you're audited.
Right. Right.
Nothing bad happens to you unless you get audited.
Right.
So that's the first thing we had to do to figure out the value of that. And so that's what we did. We figured out the net operating income. We tried to figure out what's the appropriate cap rate for this vintage. They were built in the 70s. So vintage kind of refers to maybe what decade they were. So it's 70s vintage duplex in pretty good shape. what's the appropriate cap rate? And we took that NOI, we divided it by that cap rate, and it gave us the value that we proposed to them is what the market value of their property is. Now, we don't know if we're right until we put it out to the market and we see how the market actually responds. So once we listed the property and we had it under contract for about 97% of its value, of its list value, in about a week, we were right.
Yeah.
The market responded with somebody who wants to buy them.
Yeah.
Right away. And had lots of interest, and it was good. It was really good. So it's a valuation tool.
Fantastic.
Right? Next thing is investment decision making. NOI plays a role on investment decision making. Investors use NOI to evaluate and compare different properties, helping them make informed investment choices. Right? So it's a way to compare this deal against this deal. Or in other words, you might think, all right, I can buy this strip center over here, and the NOI would be this. Or I can buy this multifamily property over here, and your responsibility is going to be different. But what you're buying is the net operating income that you would receive from either property. And so maybe I have more management responsibilities over here, and so I would need that NOI to be a little higher because I've got more work.
Yeah.
Or you think maybe because it's multifamily, if I lose a tenant, I can replace them right away because the apartments are way easier to rent than potentially retail space. If I lose a tenant over here, I might have to wait 6 months or 3 months or wait longer to get it. And so maybe I require more of an NOI over here because it's a little riskier. I want to see more cash out of the deal. And so it's just a way to make some investment decisions. Okay. It's a simple way to do it. It's a very fast way to do it. It's almost, and again, it's like a data point. It's not the thing. And I've railed against people using cap rate as their like lone decision-making criteria.
Yeah.
What's the cap rate? No, that's just a decision point. NOI, same thing. If you're a more sophisticated investor, you're probably looking more at internal rate of return, which shows what's your average annual return over the whole projected hold time of the deal.
Quick question. So when I think about net operating income, obviously it's the rent that you're getting paid, right? Minus the expenses. Yeah. Is there any more to it than that?
No, like at a very high level, that's what it is.
Right.
Okay.
There's nothing else that's you'd be getting income from than the rent.
No, there are, and we'll talk about that in a minute. Okay, there's a step in here where you add in other income.
Okay.
Which isn't rent. And we can talk about that in a second. But
okay, cool.
Yeah. Fourth thing, rather, is financing opportunities. So lenders scrutinize the NOI when considering financing or refinancing options as it indicates a property's ability to cover expenses and debt service. So here's how this works. The property brings in the rent, you pay the expenses. What's left over, so this simplified explanation, is the NOI. After that, you pay your debt service. And so your monthly mortgage. Is there enough left over after you pay the expenses of the property to be able to pay your monthly mortgage payment?
Right. Okay.
Or if you annualize it, your annual debt service. So the NOI is generally an annual number. And so what a lender will do is when they look at a property, and this is why, anytime we buy a property that's an investment property and we go to try to get financing, we do all this work for the lender. We do it for them. This is our underwriting. This is what the NOI is. We're buying it at this cap. These are our projections. And we show them, hey, look, if you lend on this deal that I want to do, I have the NOI. I know what they're looking for.
Yeah.
I have the NOI to pay the debt service and I have plenty left over to make it worth me actually doing.
Right. Right.
And that's
so
that ratio.
Lend to them and I'll show you the NOI.
Yes.
Yeah, go on.
I'll share my NOI with you,
I got
Mr.
it.
Lender.
I got it. It's right here.
So the debt service coverage ratio, the DSCR, is a very important metric to understand when you're trying to get financing for a deal or when your client's trying to get financing for a deal. The DSCR, this is one of the things that they care about a ton. And you take the NOI, which is an annual number, divided by the ADR or ADS, annual debt service. And what's that ratio? And a lot of times, they want to see 1.2, 1.25, 1.4. The higher that number, the more is left over and the more margin of error you have.
Sure.
Like things can go wrong and you still have enough to pay.
But you're looking for around like 1 point something?
A lot of times if it's lower than like 1.2 or 1.25, they won't lend on it.
Oh, yeah.
Because there's not everything has to go right.
Right.
If the debt service coverage ratio is 1, then the NOI does nothing but allow you to pay the annual debt service, and there's nothing left over. It's like, why bother? Why buy the thing?
Right.
You know?
Right. I was curious of like, what's the average or what can you typically see?
Well, in environments like this, like delinquency rates are up. So there's more borrowers out there that can't pay their mortgage.
Yeah.
In that kind of environment, you'll see banks will want more of a debt yield. So they'll want their spread to be higher.
Sure.
And because it's riskier to lend in an environment like this. And they'll want those debt service coverage ratios to be higher. When money was free a couple of years ago, you know, we had these crazy low interest rates and stuff.
Yeah.
Lenders would lend to, 80%, 85% of the value of the property. Now they might be 60, 65, 70%. They're not lending as much on each deal percentage-wise because that gives them more of a debt service coverage ratio will be higher. Their yield may be higher that way, and they're charging higher interest rate. All of that because the deals are a little bit riskier in this environment. So
cool.
Financing is a big deal. All right, performance measurement. NOI allows for the evaluation of a property's performance over time and comparison across different properties. This is along the lines, and I've told the story of the strip center we bought where the rents were around $12 a foot. And we bought it because we believed we could get the rents to about $18 a foot.
Right.
Now, what I'm doing there is while we own it, I'm trying to increase the net operating income. I want to get the rents up to market rates, and I want to keep the expenses right where they are, or manage it even better than the previous owners and get the expenses down. All right. The bigger that spread is, the higher the NOI is. Higher the NOI, the higher the
value.
Yes, the higher the value of the property. Right. So it's a performance measurement. The investors that invested with me on that deal can look at the NOI increase over time and say, Bo is doing what he said he would do.
Yeah.
So that's good. It's a way to measure performance. Not the only way, but it's a way to measure performance. And then we've talked about this a couple times, but it has its own number 6 on the list is capitalization rate calculation. You need the NOI to be able to calculate the cap rate.
Yes, you do. Yes, you do.
Yep. Last one is cash flow estimation. NOI is different than cash flow. So net operating income serves as a basis for calculating net cash flow, which is crucial for understanding the actual returns to the investor. NOI does not tell you what you're actually putting in your pocket. It just tells you what's the operating income of the property. Operating income minus operating expenses. But there's other stuff that goes on in a deal after you figure out the net operating income that you have to figure out before you understand how many dollars land in your pocket.
Yeah.
And you have to figure that out to figure out what's my actual return going to be.
Right.
Right. But you need the NOI first for all of these reasons.
Sure. But like basically your NOI then is you've got the freedom because you've already calculated the expenses. You've got the freedom to do what you wish with that money.
It's not that you've already calculated the expenses. It's that the NOI is what's left over once you've paid your expenses.
Right. Okay. Yeah.
So you're right. At that point, you may have other obligations like debt payments. But after that, this is the money that's left over. This is you deciding, you have the freedom to decide
so
what
debt
you do with that
payment
money.
wouldn't be one of your expenses.
No.
And in this case, the expense is only based on the building.
Yeah.
Expenses toward
So let's move to that because this is where people struggle and have.
All right, sweet.
And I brought you a worksheet.
Hey, baby.
Now, if you go to Google and type in APOD, which stands for Annual Property Operating Data, an APOD worksheet helps you figure out what the NOI is. All right. And it just lists it all out and you just work through it and you can figure it out.
Oh, nice.
Okay. So when I was working on this duplex and I had the P&Ls for the year for these 6 duplexes, I was putting this information into an APOD worksheet. Now, if you Google it, you're going to get a ton of different versions of this. Like when I say versions, they're formatted differently.
Sure. Okay.
Some may have more of a list of expenses than something else, but the one I have here is the CCIM version. Okay. But there's nothing proprietary about an APOD worksheet. Okay.
Yeah.
Like you can Google it and you can find 10, 20, 100 different ones. Just pick the one you like. They're all basically going to do the same thing. And this is what they work through. And I'll send you this so you can use it. But
Great.
first thing, line number 1,
Potential rental income.
PRI. You start with PRI.
Okay.
And here's what PRI is. PRI is if all the units were 100% occupied at market rates, what would they be?
Yeah.
That's your PRI. 100% occupied
Best
market
case
rate.
scenario.
Yeah. That's as good as it gets. Okay?
Yep.
Everything's full and they're paying market rents.
Okay.
Now, we're just going to whittle away after that. So line 2 says what?
Less vacancy and CR losses.
CR losses are credit losses. So vacancy makes sense. Okay.
Yeah.
If any unit is vacant, it's not paying rent. Okay. You're going to subtract that amount of rent. So if you're looking at let's say we're looking at a 200 unit apartment complex and they have 4% vacancy, right? You can figure out 200 units, average rent is this. So 200 units times that amount times 12 is your PRI, everything. But now take that PRI and subtract 4% for vacancy. That's what it averaged. You're just going to whittle that down. Okay. Credit losses are when units are occupied, but they're acting like they're vacant.
So
in other
someone's
words,
not paying.
People aren't paying. That's a credit loss. And that happens all the time.
Yeah.
All right. It happens more in multifamily just because there's more units generally and there's more turnover and
I mean,
you're dealing with more people. So statistically speaking, you're going to deal with that more.
Yeah.
I've
But
got
a lot of them might not even be business people.
Yeah,
either,
totally.
Right. Yeah. No, go ahead. Yeah.
Now I've got a 4-unit strip center, 13,500 square feet. There's 4 main tenants in that building. They all pay every month. Like I don't have an issue with credit losses, but that could change next month, right? So in a property like that, it's less common to deal with credit losses, but it's totally possible and things can change tomorrow with any tenant. So you subtract that away. So you start with PRI, you subtract out vacancy and credit losses, and then that gives you what?
You got your percentage of PRI, right? Oh, number 3, effective rental income.
Yep. So PRI minus vacancy and credit loss is your ERI, your effective rental income.
Okay. The actual money coming in.
Yeah. If you look at a piece of property, the actual dollars that they took in was their ERI. Okay. That factors in vacancy and credit losses.
Okay.
Now, the next thing you're going to do is what?
Other income.
You're going to add back in other income. And this goes back to the question you had before.
Right.
Is it just rents? No. Sometimes it's just rents. But what are some other things you could potentially think of that would be income producing for a piece of property?
Other than like being part owner of the business, right?
Yeah,
No,
just
right.
Yeah, not how you'd
ad
benefit.
space.
Okay.
Right. If you had like wanted to put a big ad on the wall.
Yes.
Yeah.
So
Okay.
that could be, or blow that up to an office building and say signage rights on the outside of the building.
Signage rights.
You drive by one of these big old buildings and there's just one big sign out there.
Yeah. Yeah.
Like they paid money for that. That's other income.
Gotcha.
Right? That's not rent. That's other income. You drive downtown in Owensboro, there's one particular building that's got a lot of big signs out of it on top of it. And our uncle might own that building. Most of the time, signage rights are pretty exclusive. You don't want a bunch of big...
It defeats the purpose to a degree.
But in this case, they're bringing in other income with multiple tenants with signage rights on the outside of the building.
Yeah, gotcha.
Okay, you don't see that very often.
Okay.
Normally it's just one or maybe one on one side and one on the other side. But
Yeah.
just think about an office building, what are some other things that you could charge for if you own that building? As a commercial real estate broker, your success depends on the right strategies and guidance. The Massimo Group, the world's top coaching organization for brokers, can help you scale your business and increase your income. And as a former client, I've personally experienced how their coaching can transform not only your career, but also your life. Don't wait to grow. Head to www.massimo-group.com today and see how their proven systems can work for you. This episode is also brought to you by Site to Do Business, the ultimate commercial real estate data analysis and mapping tool. Whether you're a seasoned professional or just starting out, Site to Do Business provides the data and insights you need to make informed decisions and close deals faster. Frankly, it's the tool that I use the most in my business. Access comprehensive market analysis, demographic data, and powerful mapping tools like ArcGIS, Placer AI, and Flood Maps all in one place. Identify the best locations for your clients, analyze market trends, and present your findings with confidence. Don't miss out on this game-changing platform. Visit stdb.com today and see how it can optimize your business. And now back to the show.
Like short-term, like the conference room rental for an hour, or
no, I'd probably still classify that as like rent for space, even if it's like, real short-term. But what about parking? You could charge for parking.
You could charge for parking.
Yeah, that would be other income.
That would be other. Okay,
that would be other income.
Yeah.
In a multifamily property, other income could be
storage.
Could be storage.
Yeah.
Great example. Laundry. Great example. Some of these places have workout facilities.
Oh, yeah. Gym.
Now, some of those are just built in. It's an amenity.
Right. Okay?
But some of them have like an annual gym fee. Maybe it's just $50 for the year.
Yeah.
Times 200 every year. Like, that's other income.
Yeah, that's nice.
That's other income. So that's the idea. You're going to add back the other income. So effective rental income is PRI, potential, best case scenario. Take out your vacancy and your credit losses. You get effective rental income. And then you're going to add back any other income. Okay. Late fees might be other income.
Okay.
Yeah. So you're going to add that stuff back in. And then what's next?
Then we have gross operating income.
Right. So now you've figured out your PRI. Mm-hmm. Then you figured out your ERI, your effective rental income.
Right.
Then you add back
other income.
And then now what you have is gross operating income. This is just like on a P&L for a business. This would be gross profit, gross income. This is your gross income line.
Gross profit could be called that too.
Yeah, it could be called gross profit. It's basically before you take out your expenses. Yeah. Then you get your net profits or your net income. But yeah, this would be your gross profit line.
Okay.
Now, now we get to our expenses, yeah?
Our operating expenses.
Yeah, so just read those out loud. What are some just listed operating expenses for property? And this is pretty general. We don't know here, but like, what are they?
Taxes, real estate taxes.
Okay, so property taxes, real estate taxes. That's often your biggest one.
Yeah.
Okay, what else?
Then you have your personal property taxes.
Okay, sometimes you're taxed on personal property, which would be, equipment, generally a pretty small thing. What else?
Insurance, property insurance.
Property insurance, yep.
Yep, we got off-site management.
Okay, so property management is an operating expense, whether it's on-site or off-site.
Okay. Payroll.
Sometimes you have employees. So think about a big apartment complex. You might employ a leasing agent, an on-site property manager, probably not a cleaner, but you'll have maintenance guys. Yep. In an office building, you might employ janitorial. So that's, if you have actual employees, it would go on that payroll line. Okay. What else?
Expenses/benefits.
Okay. That would be like benefit package to the employees.
Healthcare.
Yep.
Yeah. Taxes/workers' compensation.
Okay. Still, that's tied to the employees on a property.
Repairs and maintenance.
Okay. Repairs and maintenance. This is, you got to replace
a roof.
No. Repairs and maintenance are somebody trips and falls into the door and cracks it open, and you have to repair the door jamb.
Oh, okay.
A roof replacement is not an operating expense. It's a capital expense.
Oh, right. Because it has a life.
It has a life. There's a life to it. That roof is going to last 20 years. You don't get to expense it in 1 year. You have to capitalize it or depreciate it over 20 years. So it does not go in your operating expenses. And if you get a new roof 1 year on a piece of property, it will not negatively affect your net operating income.
Well, let me throw this at you. A tree branch falls and pops a hole in the roof. You don't have to replace the whole roof, but you got to repair the hole.
That could be an expense.
Yeah. Okay. Yeah.
What else?
Okay, great. Utilities.
So
Power,
a lot of
water,
times,
Wi-Fi.
yeah, all that stuff. But a lot of times your tenants pay their own utilities for their own space. But it's all based on what's negotiated in the lease, and different property types have norms on how that stuff's handled. We don't need to get into all that.
Yeah.
But let's just take, for example, I've got these 2 strip centers that are right next to each other.
You love to talk about those. No, I'm kidding.
Well, this is an example of this.
Yeah.
You're right. I do like to talk. I don't have a huge a portfolio of properties, so I have a very limited amount of properties to choose from if I'm going to talk about them directly. But
I've never noticed you doing it out of like, hey, I got
hold on for a second.
yeah.
Now, wait. You want to get the Chuck Schumer look?
Yeah, there we go. There you go. Okay.
No.
I've got 2 properties.
These 2 strip centers right next to each other. All right.
Yeah.
And
That's so cool.
This is so at age 48, I finally broke down and got readers. Like I wear contacts, but I got readers. And Maddie calls these my granny glasses.
Yeah.
But they really help. They really help. I finally let the old man in a little bit. Good. Broke down and got readers.
Come on, let's go. Let's go. Let's wisdom.
All right, back to this. Where was I? Utilities.
Yes.
Now, 100% leased. The tenants pay all their utilities. However, there are security lights in the parking lot to provide lighting to all of them. Right? That bill comes to me.
Sure.
And then because of the leases, I can expense the proportionate share out. It ends up being part of their CAM fees, but
coffee in the kitchen. That's for everybody.
Yeah, here in this building.
Here, yeah.
Yes. That wouldn't be utilities though.
Oh no,
that's just a supplies kind of thing, which you'll see later on. But yeah, utilities.
Okay.
And then on this particular sheet, you got a bunch of blanks to fill in your own. Okay. But what are some others?
Accounting and legal.
Okay. So those are expenses. Like every year I got to file a tax return on the entity that owns this building. If we have to pay for forcible detainer or an eviction, I might need to get an attorney. There's going to be professional fees there. So bookkeeping for this property, that'd be a professional fee. It'd kind of go there.
All right. Next is licenses and permits.
Okay. So any of that kind of stuff doesn't always apply, but could be.
Advertising.
Yeah. If we do any kind of advertising to attract tenants here, that'd be an operating expense. Supplies like coffee. Toilet paper, etc. Cleaning supplies, any of that stuff.
Miscellaneous contract services.
Okay, so sometimes, let's say I need to get something repaired. Well, I don't have a maintenance guy on staff. That would be repairs and maintenance. So I might have to contract with somebody to come in here and fix something. For example, we had an HVAC system with like a condensation pan up in a ceiling, and the condensation pan either got a hole in it or it tipped or got too full, and it fell down onto the ceiling tile, busted up the ceiling tile, which fell on the conference room table in this building.
Oof.
Easy fix.
Yeah.
Okay. But I don't have a guy. I have to contract that out, bring somebody in to, tweak the HVAC system so that doesn't happen again, get a new ceiling tile, clean up. That's all potentially contract labor.
Yeah, okay.
Okay. They're not employees. It's not necessarily.
I would be contract labor as far as like editing the podcast and.
Yeah.
Right. Yeah.
Yeah.
All right. Or whatever other videos I do for you.
All this stuff, examples of operating expenses. Okay. The idea with operating expenses are they're the normal reoccurring expenses of operating a building. So if it happens once a year, like property taxes, then that's an operating expense. If it's something you have to do once every so many years, you should probably capitalize it. It's CapEx, capital expenditures, and you deal with that differently. It does not factor in. But on a P&L statement, you're going to see CapEx. So when I'm looking at a P&L on a piece of property to figure out the NOI, I've got to go through and I've got to take out all the CapEx that they're expensing, and they probably shouldn't.
I see. You're going to see that almost always because they just lump
Almost
it
every
all
time.
in. Yeah.
Because
Is it due to ignorance oftentimes? Like, oh, these are all my expenses. Like just not knowing what exactly is the expense or.
totally could be.
Yeah.
It also benefits them tax-wise because it brings down their taxable income.
Sure.
So instead of depreciating a new roof over a certain amount of years, they expense it all in the year and they redo the parking lot. Maybe that's a 15-year depreciation schedule. They expense it in 1 year because it brings their taxable income way down.
Yeah.
And that's okay unless you get audited,
Right.
you know? Or in other words, it's not okay,
It's not okay.
but you won't get caught unless you get audited.
Right.
So
And then
That's
in that case, you go what?
big risk.
Straight to jail.
No, you get
You pay back.
well, you get penalties.
Yeah.
And then you pay interest on what you should have paid years ago.
Oh yeah.
So it hurts.
Yeah.
I mean, it hurts. And generally it hurts your pocketbook and not, where you sleep at night.
Yeah. And how you sleep at night.
Yeah.
Right. Yeah.
So
just do
if
it.
it's a normal, regular, even annual expense from operating a building, it's an operating expense.
Okay.
So you figure out your gross operating income, your GOI, and you subtract out your operating expenses, and it leaves you with
Your total operating expenses. You would add up all those expenses to get your total operating expenses to get your net operating income.
Yep. So GOI minus total operating expenses gives you your net operating income. Okay.
GOI minus toe.
That's how you find your NOI. Every investment property has one.
Yeah. Great.
And you can figure it out. Okay.
Yeah.
So here's some mistakes that people make. One is what we talked about. They'll expense capital expenditures. All right. It's no, you shouldn't do that. Most people do that so that they can bring their taxable income down. Again, nobody's going to slap your hand unless you get audited.
Right.
All right. So don't do that. That's
Don't do
the
it.
official line. Don't do that.
Yeah.
So you'll hear this term below the NOI line. What they're talking about is you do all this that we just talked through
Yeah.
to get to the NOI line,
Yes.
and debt service happens below that line.
Yeah.
That's what they mean when they say below the line.
Gotcha.
They've done the worksheet. This happens below the line. So sometimes what you'll see is interest expense, like the interest they're paying on their mortgage, up there in expenses. Or you'll see the whole debt service payment up there in expenses. That's a big no-no. And so anytime I'm looking at a P&L on a property to try to figure out the NOI, I'm looking for that stuff. Do I see interest expense in here? I gotta take it out. I gotta add that amount back to the NOI.
Yeah.
Okay.
Yep.
Another one is any kind of leasing commissions. Leasing commissions are not to be expensed. They're capitalized over the life of the lease. Or in other words, I should say the term of the lease. So if we get a $10,000 fee on a 5-year lease, so it's not all expensed in 1 year, it's capitalized over the term
of the lease.
It's a 7-year term of the lease. It'd be 7.
Yeah.
You get my point.
I got
it's
it.
below the line.
Yeah.
Okay. Let's see if I'm missing anything. If the bank makes you fund a reserve account,
Okay.
we just did with Hearthstone, Fund 2 invested in a property in Tyler, Texas. And our friends at Eden Companies out of Lexington, who we invested with, their lender was a $41 million deal.
Oh.
They raised $21 million. They borrowed $21 million.
Yeah.
Their lender made them pre-fund $1 million of interest payments when they closed.
Woo.
That's certainly not an expense.
Right.
Okay.
Yeah. Yeah. Like,
You can't
you're just paying
expense
it
that.
ahead of time.
Yeah, it's prepaid insurance
And that'd be called, and that would be in a reserve account. Yeah.
held with that lender, I'm sure.
Yeah.
Okay. Yep. So that's net operating income.
Yeah, baby.
It's how you use it. And the key is, start at the top, just work your way down the sheet. And practically speaking, when brokers are doing their thing and they're trying to put together a proposal, they're trying to figure out the NOI, when they see the financials of that property, they're going in there and they're trying to figure out, okay, that's a pretty big expense right there. Should that be capitalized instead?
Right.
And if so, we're gonna take it out.
Right.
Do I see interest payments in here or any kind of debt service? Do I see any depreciation? Depreciation is not included in NOI. Okay, so sometimes you'll see a depreciation line above the NOI line. You're like, got to take that out. And so you're looking for that stuff, because just because this is how it's supposed to be done doesn't mean that any owner out there isn't doing their books however they want to. Unless you're audited, you get to do your books however you want to.
Sure.
And so I'm not
every time you say
advocating for cooking your books or doing it incorrectly.
I hear Dad's voice being like, son, you kept saying, you can get away with it. You got to stop saying that.
Yeah. No, you do it the right way.
Do it the right way. Yeah.
Like we don't go cheap on our professional team. Like I think we've had Kevin Bassett on the podcast a couple times. Like he's our CPA. He is a proponent for doing things the right way, which is why we hired him.
Yeah.
Okay. You want to do things the right way. But the reality is there's nobody over your shoulder when you're doing your books. And so what often you see in my business when you get somebody's financials and you're like, all right, if I'm going to give a true NOI number, I've got to fix, at least on that worksheet, how they classified their expenses.
Right.
I'm not going back there and making them fix their books, or I'm not reporting them to IRS, certainly, but I have to know what belongs in an NOI number and what doesn't. And I have to have the ability to go through and weed it out and make it right.
And the fact that nothing happens to you unless you're audited is why so many people aren't paying a ton of attention to detail when they put these together.
Yeah, that could be true.
Yeah. That's why you keep saying it.
Yeah.
Right? Right?
I guess.
Yeah. Okay, cool.
So what questions do you have?
I don't know what questions do you have for me?
Well, I got a pop quiz for you.
Yeah.
All right, pop quiz.
Yeah, because I think I understand this pretty well.
All right.
Or ish.
Great. So start off with the gimme question 1.
Okay.
What is the equation for figuring out cap rate?
Well, that's net operating income over the value of the property.
So net operating income divided by the value of the property will give you
your cap rate.
Great. Okay. So switching those around a little bit.
Okay.
What's the equation for value? If you're trying to solve for value.
Operating income divided by the cap rate.
Yes.
Got your value.
Great. Okay.
Yeah.
What's the equation for NOI?
Value times the cap rate.
My man.
Hey.
Look at you doing math.
I was really trying to get it as you're explaining it.
That's good.
Yeah.
Nicely done.
Yeah.
Okay.
No, my focus is
what
on important
is
things today.
the worksheet that you fill out to try to figure out the NOI?
APOD.
And what's that stand for?
Annual percentage of debt. That's not what it is.
That's not what it is.
But annual, is that right?
Yes.
Annual. Annual profit. No.
Okay. Let's just figure it out.
Okay.
If we're talking about commercial real estate and you have a P in there, what's
property.
a property?
Annual property of. No.
So what's NOI?
Operating,
Yeah, there you go. Say it.
Debt.
No.
Nah. Annual property operating delinquency.
Data.
Duh.
Annual property operating data.
APOD. All right.
I just saw the thumbnail.
You did?
For this episode. I'm doing my Chuck Schumer impersonation, and you're going.
Net operating income.
Okay. All right. Question 3.
Oh, we're on. Oh, yes, of course. Yeah. Question 3.
Question 3. Name me 3 ways NOI can be used in commercial real estate.
Sure. Potential earnings or the potential profit. Potential something.
No, it is a profitability indicator.
It's profitability indicator.
Good. So that's 1.
Investment helps you make an investment decision maker, or helps you make investment
That's number
decisions.
2. Mm-hmm. It's a data point to use to compare investments and make a decision. Great.
Financing opportunities.
Yeah, after you snuck a look. Yeah. So lenders.
Cap rate.
Yeah. Lenders look at your NOI to see if there's that debt service coverage ratio. Is there enough NOI left over for you to pay?
Right.
Their debt. Okay, great.
Great.
Ding, ding, ding. Question 4. Explain to me what people mean when they say below the line.
Below the line, you've got the list of everything when you're trying to come up with the net operating income, which includes all the expenses that you got to take out, as well as the money coming in, the income, other income. And once you have the net operating income, there are another list of things like lease commitments, or I don't know, commissions, the capital expenses, those things that would be on that sheet, that APOD, but they would be below the line because they're not being factored or calculated in.
That is correct. Question 5. How many years have I been married?
25. It would be 25 in December.
This is 25. Okay,
year.
great.
Yeah.
Now, let's back up just a second.
Okay.
So nice job on the quiz.
Thank you.
Let's follow this NOI worksheet down there. So you figure out income, figure out the operating expenses, the regular ongoing expenses to operate that building. It has everything to do with the building and nothing to do with who owns the building. Like no debt service in there, none of that stuff. Okay. And then you get the NOI. Now below the NOI, you have your debt service, any kind of CapEx. Now, when you're trying to figure out if I buy this building, how much money can I take home to mama?
Yeah.
That's cash flow.
Right.
Has nothing to do with NOI. Okay. Now, if you're buying a brand new property that has no CapEx, it's just, when you buy it, it just happens to be brand new and fully leased. Right. So you have no leasing commissions. You buy it with cash, so there's no debt on it. Then NOI would equal cash flow. Make sense?
And that's rare. I mean,
it's rare.
Yeah.
Okay.
Right. Okay. No, that makes sense.
Now, if you and I go buy an office building right now,
sure.
There's probably going to be some vacancy. There's going to be some CapEx. We're probably going to have to fund a reserve fund when we buy it to satisfy the lending if we put debt on it. And we're going to have to take our NOI after we collect all the rents, pay all the expenses, then pay debt service and all that stuff. Then we get down to cash flow. And it's cash flow before taxes.
Yeah.
So we haven't even talked about income tax yet.
Right.
So it's cash flow before taxes. And if we're partners in this deal, we would split that money. You'd take some of yours home. I'd take some of mine home. And then if we're in different tax brackets, then you have to pay taxes on your part, and I pay taxes on my part, so that you go from NOI, take out all that other stuff to get to cash flow below taxes.
Yeah.
Then you pay your income taxes, which is specific to the actual investor.
Yes.
And then you get cash flow after taxes. And that's what the investor has to spend.
Yes.
They can use that number or that amount of money to go buy a boat or turn around and invest in something else or do whatever they want.
Sure.
Take their wife on a 25th anniversary trip.
Yeah.
So like NOI isn't the end of the equation when you're figuring it out, but it's It's the first number you got to figure out when you're evaluating a property.
Right, because you can't get to cash flow without knowing your net operating income.
Yeah, and you can't figure out is what the cap rate is on a deal.
That's right.
And if you figure out the cap rate, then you can compare it to other investments out there. And there's all these things that are built on top of net operating income.
Right.
The lender can't figure out what the debt service coverage ratio is. And if you don't do the underwriting and tell them what the NOI is, they're going to do it. And they should verify all your work anyway, but they're going to have to do it. In every part of the process of underwriting and purchasing and then operating a piece of property and then ultimately selling it, you're going to sell it based on the NOI. And you should operate and manage the property as you own it to increase the NOI. That's going to increase the value of your property. So you're looking to increase rents over time. Hopefully the market will just naturally rise during that time. So just natural market rents will go up, but you want to, minimize expenses.
Yeah.
That's just increases your NOI. And then ideally, the cap rate is favorable when you want to sell in the future. But regardless of what the cap rate does, which you can't control, you can manage the property to increase the net operating income, which means the property is producing more profit.
So
it's worth more.
Yeah. So if I'm going to, I'm looking at a strip mall, right? Or a strip center, and I look at the net operating income, that's only the beginning of the process as far as me deciding whether or not I want to do it. Because if the net operating income seems low, that probably a good chance that means that's a great opportunity.
Could be,
because they're not, whoever's running it is not, good at upping the prices to market rents or whatever.
That's exactly right.
Yeah, you're not making really not making any decisions based on that alone, whether that's high or low. Unless you go in, you're like, oh, the net operating income seems kind of high here. Then even in that case, you're like, oh, that's great.
Not necessarily.
Yeah.
So let's talk this through a little bit.
Great.
Have you ever heard of sale leaseback?
Yeah.
So maybe we do an episode at some point on a sale leaseback.
I think we talked about it when we had Jim Rosen on.
Yes.
Yeah.
That's right. We did. Hey, Jim.
Jim. Shout out to Jim.
So.
Because he's a 101 guy. Or wait, what does he teach? 101?
He teaches 103. He may teach 101 as well.
But we went through 103 stuff.
Yeah. And so the idea of a sale leaseback is you own a building, you occupy the building, but you sell the building, but you stay occupying it. So you turn yourself from an owner into a tenant. And you offer the market, here's a lease that I'm willing to pay. I'm willing to pay this rent. So you can buy this property, and I'm offering up the NOI as opposed to buying a vacant building and finding a tenant to occupy it.
Sure.
So I know I can buy this building and they're going to be paying rent day one. I can see what they'll be paying. Here's the terms of the lease. I know exactly what I'm buying.
Right.
Okay. So it's a way for an owner to access a lot of equity that they might have in the building by turning themselves into a tenant. Now they're able to expense their rent. You don't get to expense your mortgage payment. There's some other advantages of turning yourself into a tenant. Okay. But you're paying rent. Well, imagine this. Imagine I am a doctor and I own a doctor's office. Okay.
You look good in that doctor coat.
Thanks.
Yeah.
So I'm a doctor. I own the thing, and I'm willing to do a 10-year lease.
Glasses on? Yeah. If you're going to be a doctor, this will help.
Yes.
Okay. There we go.
I'm willing to do a 10-year lease. A 10-year lease at market rent. Okay. And so let's say if you buy the building and you've got a 10-year lease from a doctor who's probably got a lot of financial wealth, and they're going to sign personally on the lease. And man, for 10 years, I'm going to get that rent.
Yeah.
Like I'm willing to pay a pretty nice low cap rate, high value, because there's not a ton of risk.
Right.
Because that doctor makes a ton of money and he's going to pay his rent.
I mean, he's been there for a long time anyway.
Yeah. So
cool glasses. Seems like a really cool dude.
Yes. Yes.
Silver Fox. Someone say Dr. Silver Fox.
Dr. Silver Fox.
Yeah.
Okay. So that's market rent. The other thing you're thinking is if that guy retires and goes away in 10 years, I can replace him with somebody else. And since I've bought the building based on market rent, I feel pretty good about my ability to replace him with somebody else at market rent. And then I might lose some months of vacancy or stuff, but like no problem. But let's say I offer to the market double the market rent. I want a lot for my building. And so I'm going to pay double the rent of market and
to make it more enticing
for you to buy it.
Yeah.
But then when I retire in 10 years and I go away, what do you replace me with?
Half the rent or
market rent.
Yeah, market
which
rent.
is half of what you're paying. So you overpaid for a building that wasn't going to be able to sustain the income that you were buying.
Yep.
So when you do a sale leaseback, you are constrained by the market norms of rent. If the buyer is going to buy the property at an inflated value because of inflated rent, guess what? The appraisal's not going to take that into account. And they're not going to appraise it at that much, which means the financing probably won't come through on it. And you can have a lot of problems. So it can, it's like.
So yeah, I see.
See that?
Yeah.
So
I
yeah.
understand that. Yeah. Cool.
But this is like the bread and butter of brokerage, especially when you're underwriting a property. You're dealing with NOI and all this PRI, ERI, total operating expense, below the line, DSCR, all that stuff.
Yeah.
That's 101 stuff. So McNeill, hopefully that was helpful to you, my friend.
Yeah.
And
that's right. And on that note, if you want us to cover anything else, I mean, I'm sure there's other 101 topics we can go into as well. And we'll sprinkle them in there. Sprinkle them in there. But yeah, let us know in the comments if you've got anything specific you want Bo to cover. And I'd love to learn it. So
I have one other thing.
Oh yeah. Okay.
Totally different subject.
Sure.
But I had a call with Superpowers the other day.
Superpowers HQ. That's where you get the you can get yourself a virtual assistant.
You can get yourself an Alice.
Yeah, superpowershq.com/commercially speaking. Go get you one. Let them know
this is cool.
We sent you.
I think because of our podcast episodes that we've done with Alice and having the Superpowers guys stuff on.
Yeah.
They're starting to get a lot of the commercial real estate industry come for executive assistants.
Nice.
To the point where they actually had a conversation with me about, could Alice help teach some of these EAs to serve commercial real estate professionals like Alice helps us.
Right.
And it was really just kind of a cool thing. So if you've ever wondered if you could get an Alice, the answer is no, you cannot have Alice. But Alice can help you, or can help your EA do some of the things that Alice does for us. So she can get you there quicker.
Yeah.
Which I thought was pretty cool.
That is really cool.
So if you're interested in that in any way, where do they go?
Superpowershq.com/commercially speaking.
Commercially speaking.
Yeah. I wonder if we can get them to change that to CS or something.
Maybe so, but
yeah. Anyway, that's a note I'll miss.
But that'll take you to a place where you can sign up for like an intro call.
Yep.
And just tell them we sent you, and that
we love them.
That you want Alice to help train your EA.
Yes, that's amazing.
We can help that.
That's amazing. If you're watching this on YouTube, hit subscribe, ding that little bell, leave us some comments, share this. The comments we love the most are ones that, of course, that let us know what you like about it. But the ones that we like even more than that are the one that are you letting us know what you want to learn, because that helps us as we craft the show. Also, you can follow us on social media at Commercially Speaking. On X, it's at ComSpeakPod. Every single week, we have a free newsletter that comes out. How do they do that?
Yeah, where do they go? Subscribe.wgbarron.com. Subscribe.wgbarron.com. And what we do there is we send out a weekly newsletter. It's got just curated articles on everything from leadership to commercial real estate to negotiations to culture of a company. All these things I like to geek out over. We put together. Also, we'll have the latest episode of the podcast delivered to you, so you never have to miss one.
That's right.
And
that's it.
Yeah, we'd love to have you there.
The Westgate. Let us know what that is one more time.
If you go to westgate.com/CS, you can throw your name and email in there, and you'll essentially be on the wait list for the CRE Marketing Mastermind. We'd love to have you over there.
Such a good idea.
No commitment there. Just when we've got the information ready, we'll send it out to you guys first, and we're only going to take 40 in this first group. We're going to take through the mastermind, and and you'll get first dibs. So
Love it. Amazing. I want to thank Massimo Group and Site to Do Business who are sponsoring this episode. Thank you so much. We really appreciate that.
yes, we do.
And yeah, we'll see you next Monday. Love you, brother.
All right. Love you, man.
Bye, Alice.
Bye, Alice.
Happy Valentine's Day.